just recording. Okay. Okay. So okay, let's start. So like I was saying, in the so when we started, the reason why basically we do accounting, what's the objective of accounting? I said the objective of accounting is basically to present useful information to users, right? And what is this useful information? It's statements or notes, right? So presentation or disclosure. However, we focus like in varsity, the main focus is on presentation. Yeah, so the main focus here is on presentation. So how to present those statements, right? So we're gonna look at statements. There are four statements. It's the statement of cash flow, statement of changes in equity, statement of profit and loss, and the statement of financial position, right? However, the most uh, all of these statements, like I said, they are there to give information, right? Useful information. However, out of the four, the one that gives the most information about like the business is the statement of financial position. So that's the focus of that's the focus here. The statement of financial position. That's the focus for most accounting topics, especially on a third year level and a CTA level. So the focus is on the statement of financial position. So now let's look at the financial position. Ne- Obviously, the focus is on the statement of financial position and the statement of profit and loss, right? However, the statement of profit and loss just reflects the changes in the statement of financial position, and I'll show you what I mean. So it just reflects the changes that happened during the year on the like for the statement of financial position. So the main important statement is the statement of financial position, right? So what happens is now this statement is divided into right? There's the assets part and there's the liability. So there's the assets part and the liability and equity section, right? Now, the assets part, this is something that's very important, and it's also very relevant to what we're going to do now. So when you start include statement. So the assets that you see presented on those statements are the assets that the entity can control. So as long as the entity controls those assets, then those assets will be presented on the statement. Hence, the definition of the asset in the conceptual framework includes control in its definition. So the entity must be able to control those assets, number one. So whatever assets it controls, it will be presented in that statement. And then when you go to the liability section and the equity section, that liability and equity section, right? We said it must be equal to assets, right? It must be equal to assets. Why? That's because those assets must be funded. So those assets must come from somewhere. Assets come from somewhere, right? So it's either we funded those assets or liabilities, like we got money from the banks to fund those assets, right? Or those assets that we have were funded by our previous returns, by our retained earnings, right? But that section on like that section after assets, that bottom section, so equity and liabilities, those are the funding funding options that funded those assets. Ne? Now, we as accountants, ne? So for something to be presented in the financial statement, so statement of financial position, right? It has to be presented in a certain way, right? And what do we use? We use standards, right? These standards, IFRS. Do you see IFRS? These are international standards. So what does it mean? It means that even if you were to put a person maybe from I don't know what countries other than South Africa use IFRS, but I'll use maybe UK. So if you like a person from UK was to come here and record what's happening, they would come to the same conclusion, right? Because they're using the same standards. So what you are here for, like in school, they are here to basically help you, like they're teaching you how to interpret these standards. They're teaching you how to interpret these standards. And what happens is now, there are two types of standards, and this is very important. I hope this, like you note it down. So there are two types of standards. There's a main standard and there are underlying standards. So main standards and underlying standards. So main standards and underlying standards. So what is a main standard? A main standard, you'll see in most cases, it's a standard that has a balance. So those main standards, you'll see them like in the statement of financial position. So those items that are listed on the statement of financial position, most of them are main standard. And I'll also illustrate like what a main standard and an underlying standard is like further. So what happens is something like, for instance, PPE, it's a main standard. IS 40 is a main standard. Because it has a balance, because it has a balance. Even loans have balances, therefore they are main standards. Now there are standards also like IFRS 18, maybe the fair value standard. There are standards like impairment. Those ones are not main standards, they are underlying standards, and I'll explain now what that means. So do you see that impairment and, let's say, fair value, they are not main standard because they don't have like really a balance. Impairment, it's either you are impairing what an IFRS 16, an IAS 16 asset, right? You are impairing something, but impairment itself, like, it doesn't have like a standard. It influences other standards, but it doesn't have like a standard on its own. Even something like IAS 12, like deferred tax, it doesn't have like deferred tax. It doesn't have. It's not a main standard, but it affects every single one of those main standards. So underlying standards, they just affect like the main standards, and then the main standards, like, they have the balance. So for instance, if you're doing something like let me give you another example, like fair value. So fair value, like, that standard, the reason why we do it, like, for instance, if we are going to do something like let's say we're doing like investment property, IS 40, right? For IS 40, they said you use basically either fair value or cost model. What if the business maybe uses fair value model? That standard, like, it gives you sort of like a way of how to calculate that fair value, but you need to calculate the fair value of a certain balance. Do you see? Like, that standard on its own, like, it doesn't apply on its own. It's dependent on other standards. So you have to know exactly and know the difference between the main and underlying standard. However, I will write that list down of them, so categorize them for you, the main and underlying standard. I'll send them by next week. I'll send them because it's very important to know that. And then now I'm gonna continue with those main standards. Main standards, what you need is a timeline, because that's a balance. So for all main standards, you have to have a timeline, right? Because, like, for instance, let's take IFRS 16. You get an asset maybe at the beginning of the year, right? You're gonna use that asset, and as you use that asset, you're gonna accumulate depreciation, right? So you need a timeline to show you that there's actually depreciation, right? Like, for instance, if, let me give an example. If you have, let's say you are doing a question on impairment, right? You see that there are impairment indicators. The first thing you know is that impairment does not have a standard on its own, right? So you can basically draw a timeline for it. However, you know that you are impairing something. So the first thing to check is, what are you impairing? Let's say you are impairing IFRS 16 normal PPE, you are impairing normal PPE. So what's going to happen before you start with the scenario? This is very important. Before you start with the scenario in the question, you have to firstly draw the timeline and think about IFRS 16 and what affects it. So for instance, you see that they have this asset, right? You know that what's the only thing that affects the balance of PPE? You know, for instance, is if maybe we do improvements to that asset, right? We make improvements to that asset, right? Or we sell a part of that asset, or we sell that asset, right? That's where the changes happen, right? And when the change happens, or there's an impairment, there's an impairment. And when that change happens, right, or impairment reversal, so when those changes happen, what must you think of? Now that you have this timeline, you will see that there's actually depreciation before these changes. And you see these small things. These are the small things that, like, we fail in accounting. When it's not the major concept. We understand, like, what impairment is. We understand what IFRS 16 is, but it's just a matter of, like, we like the way we do our journal entries. We don't have like a sequence in which we do it, and we need that process. I'm telling you, with a process only, you can get away like with 60 marks without actually knowing like main concept, especially like in CTA. Like I see it here like in CTA, even like in a third year level, because even with third year, like last year, yeah, even third year, like on a third year level. So even with third on a third year level, the last year I used to get like I would say subpar marks until like I started to see that this thing is actually a process. Yeah, so please, every time you do a question, use a timeline. Like there's no way you're gonna get all of that information from the scenario while you're reading the scenario. Because what happens is you're gonna read the required, then the scenario, the required, then the scenario, and that wastes time. And do you know what they also do in these tests? They like to put information, let's say information that relates to year end first, and then they are going to put information that relates to the middle of the year after. So what happens is, let's say you start journal entries, you're going to start with the journal entry, right? And then you're going to do it, and then after you're going to see that there's some information later that I had to consider. And what are you going to do? You're going to scratch out and waste time, and that also increases basically it increases your anxiety in a test, right? So the best thing to do is have that timeline, and then as you're reading the scenario, mark where it will change. And then after you read the scenario, now you have your timeline, just account for everything, because you'll see accounting is just accounting. We're just accounting basically for everything. And especially on a group level, group statements, what's nice about it is that like we are not focused on identification, you're only focused on journal entries. So as long as your journal entries like are on point, then you're okay. Because what happens is once your journal entries are on point, then I am sure that your statements will be on point, right? Because journal entries are basically explaining statements. If you just accumulate those amounts in the journal entries, you'll find amounts in the statement, right? So now let's start with groups. So group accounting, you will see it has a lot of standards. Like it has a lot of standards. Prescription of group accounting is in a lot of standards, not only one standard. However, I am gonna basically I'm gonna refer to it as one main standard, because basically we are doing one thing. So I'm gonna refer to it as one main standard, and as a result, it's going to have its own timeline, right? So now let's start. What is group accounting? Yeah. So firstly, the business. So firstly, right, the business, an entity. So when an entity buys a stake in another entity, right? So a business buys a stake in another business, and a stake, what is it? An interest, so shares. So that they're buying an interest in that business. So in most cases, it will be shares, when it will be represented in shares, but it's basically you are buying a share of that company. So when an entity buys a share in a company, right? The first thing that entity will do is determine the degree of influence it has in that entity. And this is very important. This part of degree of influence is very important. So the first thing is the entity will determine the degree of influence, right? What does this mean? And how do they determine this degree of influence? Let's continue. So firstly, it says how to determine the degree of influence. So now, like I said, when you're starting with group statement, did you see where it starts? It's very important to know also, like I said, accounting is a process. To know where this thing starts, it starts when an entity buys a stake in another entity. So when an entity buys shares in another entity, right? Now what happens? The first thing is you have to determine the degree of influence, right? So the degree of influence is basically how much influence you have in that entity, right? So the first thing you determine is control. The first thing you determine is control. So whether you control that entity. So now how to determine this control, so this control basically requirement, how to determine it, I will do that one later. It's not part of this topic, but firstly you have to determine whether entity A controls entity B first, right? You have to determine whether entity A controls entity B. That's the first thing you do, right? And then secondly, if entity A does not control entity B, then you check for joint control, right? That's another level of influence. So this is the first degree of influence, control. The second one you check for is joint control, but you never check for joint control before checking for control. However, I will do basically a whole session explaining basically how to determine this degree of influence, right? Because it is also important. Then after, if it's not joint control, then you check for significant influence. And if it's not significant influence, then there's no influence, meaning it's IFRS 9. I wanted to come to this point. Now, you will see when you're doing, I think you did even see it when you're doing questions, even like from second year, that sometimes we account for investment like using group accounting rules, or sometimes we account for it using IFRS 9 rules, because some investments are like financial asset. Like for instance, if we buy shares, it doesn't mean when we buy shares in a company, we always account for it using group accounting rules. It depends on the level of influence we have in that company, right? So that, in terms of like how to determine that, I will explain in another session. And then with this one, this one, so the fourth one, if there is no significant influence, then this one is not even part of group. So if there's no influence, so there is no significant influence or joint control or control, then it's not even part of the group accounting basically. So let's continue. So what happens is, I said I'll do this in the next session. So now we are going to assume that we have control, because that's where it starts, right? So we assume that we have control, so we control this entity, right? So what do we do, or what happens now? After we've determined control, that now we control this entity, right? Now we have to start accounting for it, because now we know that we control it. So we know the scope basically of it. Now we have to continue with the implication. Now that we know that it's we control it, how do we account for it? Before now I start, now I want to explain the concept of different statements. There's a difference between separate statements, combined statements, consolidated statements. So firstly, what are separate statements? So separate statements are normal accounting that you do, like when you're when you're doing like accounting normal, you are doing it in your separate financial books, right? So that's when what they mean when they say separate, they mean from that entity's perspective. So not from a group perspective, it's from that separate entity's perspective. So let's say you see like here, A controls B, right? So when I say separate books, I mean A will prepare its own financial statements, right? And then B will also prepare its own financial statements, right? Using their own perspective, right? A and B will create this. So they will have separate financial statements, right? That's what separate means. Now I'll explain what consolidate. Then what happens is, okay, I think consolidation, I will explain it later on. So what happens is, in this separate statements now, everything that I'm going to talk about, you will see I will refer to separate statements, combined or consolidated. So now I'm still focusing on separate. So what happens with separate statements? So what will happen when now you've determined that this entity, you control it, right? So the first thing that will happen that you have to know is NP. So a parent shall prepare consolidated financial statements, right? Now, this is very important. This is also listed in the standard. So a standard says, as long as you are a parent, you will prepare consolidated financial statements. Then the unless part, there are other requirements for that. You can find them also like on the standards, but in many questions, this is not really important. We already know this, that we have to prepare consolidated financial statements, but where it comes from is this, right? So a parent prepares consolidated financial statements, right? Now that you know that, so you know that we are definitely gonna get, so we know that the parent prepares consolidated financial statement, unless what? So the first thing to consider now is this, whether the parent will account for the investment in its separate financial statements, right? But you only consider this if the parent has 100% stake in the entity. So this is what happens when you control an entity. Ne? I will use, so for now, I will use percentages. I won't use other rules because there are other rules for determining control. I'll use percentages. So I'll use so when you have like more than 50% you control it, I'll use that rule. It's not always the case, but I'll use that rule for now to illustrate this point. So let's say you bought maybe a 60% stake in the company, right? Do you see that you don't have 100% stake? As long as you don't have 100% stake, then you are definitely gonna prepare consolidated financial statements. There's no way around it. So as long as you don't have like 100% stake, the parent does not have 100% stake, you're going to prepare consolidated financial statements, right? And then if they have 100% stake in an entity, it's either two things will happen, right? The parent can choose to record that whole investment in their separate financial statements, or if they don't choose to do that, they will also prepare consolidated financial statements. However, this choice is only for if you have 100% stake in the entity. Then the parent will account for that investment in the separate financial books, right? So there won't be any consolidated financial statements, meaning that they are prepared, right? So you won't have any consolidated financial statements that are prepared, right? And now when I illustrate this, and you see this one that I'm talking about, where consolidated financial statements are not prepared, that one is an unlikely scenario. Like I've never even seen it like with like they ask it in test. However, um, it is something that's in your syllabus that you have to do, right? However, in most tests I haven't seen it. They would rather have you prepare these consolidated financial statements, right? So what does it mean? Obviously, if you bought 100%, now let's go to the example where you don't prepare consolidated financial statements, right? Because you have this 100% stake. So the parent has this 100% stake and they are not preparing consolidated financial statements, right? What are they gonna do to account for everything they bought, right? So firstly, okay, before I go there, so that one of the 100%, I will explain after. I'll explain after, because it's just similar to consolidation. And what's more important is this consolidation. This is what's more important. I think even in the test that you're gonna write, like I think you're gonna write a test in August, or that test you're gonna write, that fourth test that you're gonna write is gonna have consolidated financial statements. Yeah, so what happens is, now let's take all other examples. Yeah? So all other examples. So you have, so the parent doesn't have like 100% stake in that company, or the parent has the 100% stake, but they're still preparing consolidated financial statements, right? What will happen is, because the parent is preparing consolidated financial statements, right? In the separate books of the parent, the investment will always be at cost. So you won't make any changes to that investment. That investment will always be at cost. What it means is that it will be at the level of the consideration that you paid. I'll explain what that also means. So it will always be at cost. That investment in the separate financial books of the parent will always be at cost if you are preparing consolidated financial statements. So even for these ones, all of these ones, obviously except no influence, because no influence is not part of group statements. Even all of these ones, as long as it's part of group accounting, in the separate financial statements, it will always be at cost, that investment, always be at cost, right? And then what we do, so it will always be at cost, right? Number one. Then now, so it'll always be at cost. So what's going to happen when entity A buys entity B, so controls entity B, and we know that it's going to prepare consolidated financial statements. Entity A obviously has to record something. Obviously for entity B will not record anything because it's not issuing new shares, right? Unless entity B was issuing new shares, but entity B is not issuing new shares. It's just existing shares that we bought, right, from other shareholders. So it has no impact on the statement of B, this acquisition of that business. You understand? So from B's perspective, like that's what I'm saying, like perspective in groups will be like, it's very important. You have to know who you are and like how this thing will work. Like for instance, entity B, like I said, it was transfer of ownership between shareholders. It has nothing to do with the entity itself. The entity didn't issue new shares. It didn't buy back shares. It didn't do anything. The entity even didn't receive any consideration, right? Now it's the people who actually bought. So it's the people who actually receive that money. And when you receive that money, obviously you've transferred your stake, right? So that consideration that you have, it's not part of the business. Okay, can they ever ask us to account as entity B? No, they won't ask you to account for as entity B, because there is no there is no accounting entry there. However, in the separates, yeah, they might ask you that in the separate financial books of A, what will happen, or in the separate financial books of B, what will happen. But it's very uncommon. It's very uncommon. And even if they do ask you, it will most probably be maximum 5 marks. It won't be a lot. What they are really concerned about is this consolidation, and I'll show you why they are concerned with it. So however, to do group statements, you have to know what's going on in both entity A and entity B. If you don't know what's going on from their perspective, then you're not going to get group statements. Yeah. So in entity B, like I said, there's nothing that happens at acquisition because they are not issuing new shares, right? It's just shares being transferred on the secondary market. So it's not a primary market, right? And then what happens is now we are at acquisition, right? Now the acquisition date can be anywhere, right? We can acquire the business at any point in time, right? But in most of your questions, you'll see that acquisition of the business will be at the beginning of the year, because they don't want you to do an interim acquisition yet. So for your guys' level at this point, it will be that acquisition, you'll acquire that business at the beginning of the year. It doesn't matter what year, whether it's the beginning of the current year or it was the beginning of other previous financial years, but it will always be at the beginning of the year, because you are not yet doing interim acquisition. Until you do interim acquisition, then you can it can be anyway, right? So entity A will acquire, right, entity B. So entity A acquires entity B, right? So normally what's going to be in the statement, like I said, it will be at cost. Let's say entity A bought entity B last year. So what happened last year is that A recorded or let's say we bought this entity B. So A, we bought this entity B this year at the beginning of this year. How did we record this thing when this happened? So we entity A, I get entity A is the parent. The parent is the only one that's going to record this transaction, because the parent is the one that's actually buying, not the equity holders of the parent. So the entity itself, it's actually buying shares, right? So what are we going to record? So the first thing they're going to record is investment in B, right? So investment in B, we're going to debit, right? And then the consideration, we are going to credit. So consideration, we're going to credit at fair value. Now, this is what I want to talk about, this consideration. So firstly, we are going to debit the investment. So this is in the separate, you see, separate financial books of the parent. We are not yet at consolidation. So we are not yet at the consolidation. We are still at acquisition date. So when we are acquiring that business, what general entries are we going to process at the date of acquisition? This is what we are going to process in the parent separate financial books, and the subsidiaries, nothing, right? So what happens is we are going to firstly credit the consideration that we paid at fair value, right? And what do they mean when they say this? So firstly, there are many different types of consideration. Firstly, that's why they use the term consideration, not cash. So there are many different types of consideration. It can be cash, it can be assets, right, or other assets, right? So this consideration, it can be anything. Like for instance, we can pay using our asset, right? We can transfer an asset to those shareholders. So it can be anything, this consideration. The main thing is that this consideration must be at fair value. Now with cash will always be at fair value, right? Cash will always be at fair value. And So that one, it doesn't really have a problem, right? You just put in bank, they will always be at fair value. Now let's look at other types of consideration that you can use, right? So the first one, the first one that the first one you can use is non-monetary assets, right? So non-monetary assets, I mean things like PPE, investment, property, intangible assets, right? All of them, right? Most of them are recorded at cost, right? Okay, investment property, at least it's recorded at fair value. So even if you are paying using that investment property, that amount will not change because most probably it's at fair value. But you listen to what I'm saying, most probably not all investment properties measured at fair value. It's a choice between fair value and cost, right? Just be sure to see whether they are using fair value or cost. So here I'm coming to this consideration. Those items, in most cases, they are recorded using cost, right? They are, like, for instance, even the intangible asset, they are recorded using cost, right? Because after you depreciate or you amortize, right, it's recorded cost in most cases. Now, do you see this consideration? They said it must be at fair value, right? So the first thing you're gonna do is you're gonna determine the fair value of that asset, right? So they're going to give you the fair value of that asset. Now you have the cost of the asset. What you're going to do is you're going to adjust the cost of the asset to the fair value first before you do this journal entry. So you're going to adjust the fair value of that particular asset, right? Firstly. So if I can give you an example, let's say the fair value of land was 100,000, right? And then the in your books, the carrying amount at that point was 90,000, right? Do you see there's a difference? Now, the first thing you're gonna do is you're gonna increase the value of that particular asset, right? You're gonna increase it by the 10,000 because the difference is 10,000. So you're gonna say, let's say it was PPE. So PPE, you're gonna debit with 10,000, and then gain or loss on fair value adjustment, you're gonna so in that case will be a gain because it's credit. So gain gain on fair value adjustment, you're gonna credit the now the asset is at fair value. So here what you're gonna do is you're gonna say the investment you debit, right? And then the asset itself you're gonna credit. Now do you see that you took out the entire amount of the asset? But the main thing that you have to know is that this consideration must be at fair value. It must be at fair value. That means that everything here, so everything here in this investment account, so do you see that this investment account actually in the separate books, it's an accumulation of the consideration that the parent paid. So this investment will always be an accumulation of the consideration that the parent paid at the fair value at the date of acquisition. So even let's say we use something like maybe shares, maybe like something like shares, maybe it will also be at the fair value of that share at that particular at acquisition. So fair value at acquisition is very important because even the date is very important. So fair value when at acquisition. So they might give you like many fair values. That's also something you have to look out for. You have to use the one at acquisition, right? Then now you have this investment amount in your separate like financial books. This is what you have. This is what we mean when they say the investment is at cost. Now we have this investment amount in our separate financial books. So far, what do we have in our separate in B's financial books? We don't have anything, but in A, we have these consideration. Obviously, it's many. You can say so here. It will look something like investment in B, credited by maybe bank, PPE, like all the consideration that you use, it won't be like consideration here. You will just write the accounts themselves, right? And then that's basically how they account for it, like when they start, right? So at the beginning, this is how they account for it, right? So you will see in most questions you're gonna do in future, this part you are not gonna do because it's done in the separate financial books. However, you must know how this thing was calculated because you're gonna need to know what is the amount of this investment, right? In the separate, you're gonna need to know this amount of the investment in the separate, and now you know that the amount of this investment in the separate is actually the consideration at fair value, right? It's the consideration at fair value, and it includes even contingent considerations in here. However, I will go deeper or in detail as to like how to account for this when you are doing like examples. For today, I just want to touch on a very like surface and introductory level, like this group statements, because what I've seen is that in most basically so the way we are taught like group statements is that they divide the work, right? And I what I've realized is that the way they're gonna test it is they're not gonna test it like they're gonna test it like everything at once. They won't divide the work. And if you are used to studying maybe chapter 3 today, 4, that won't work. You have to do group statements all at once. So what I'm going to do is I'm gonna touch on a few things today. So on an introductory level, and now I'm gonna go deep so that you have that surface understanding first before we go in detail. So this is what happens first, right, in the separate. Now, what we are gonna do is we are gonna go to now this is what happened in the separate of A. In B, we said nothing happened, right? Now we're gonna go to the bedrock of group statements. So the reason why we are doing group statements. So what happens is we at the end of the year, because because A controls B, right? At the end of the year, it must prepare consolidated financial statements, right? At the end of that reporting period, it must prepare consolidated financial statements, right? And what does that mean? What does that mean? It means that the parent must prepare statements, right? It must prepare financial statements from the group's perspective. It must prepare statements from the group's perspective. Now, what is the group's perspective? This is the group's perspective. Let me show you what the group perspective is. So you have this entity A, right? This is entity A. And you have this entity B, right? And you have this group, which is called group A. So it's called the group statements of A. The group statements will always be like with the name of the parent. So this is the A group basically, right? This is entity A, entity B. Then this is the group A. So for the group, right? Now, what's going to happen is all of the entries that happen from at acquisition, right? Right? Since you acquired this business A until the end of the current year, right? Until the end of the current year, you are going to record basically in these statements, in these financial statements, right? But looking at it from this level, this group level, right? So let me give you an example. Let's say A sells to B, right? God, it's an example that you're gonna get. Let's say A in future it sells something to B, right? And B does not sell this thing to outside parties. B keeps it in here. What happened on a group level? Do you see that although in the financial statements of A will record a transfer of asset to B, and B will record a purchase of an asset, right? What will happen is from a group A, like from group A perspective, nothing happened. Do you see? Nothing happened because there was no transfer to outside parties. Do you see? Do you see that A is outside of B, right? That's why something happened in the statement. Something actually got out. Then B is separate from A, right? So in the separate financial books, they will record something. But from a group perspective, nothing happened. And you will see this is basically what we are doing, right? Now, don't forget, A prepared his financial statements in the separate, right, using his own perspective, and B prepared the financial statements using his own perspective, right? Now, what happens firstly is when you prepare these consolidated financial statements, it becomes a bit complicated because do you see now A and B, like the way they record things, it's not the same as what will happen on a group level, right? Not all of it is the same. Most of it, yeah, it's okay because they are both using IFRS standards, right? However, if we just combine these things, if you just combine these things, it won't work, right? It won't work because that's not what happened on a group level, right? So what happens is this is where it starts, right? what happens is, you know that A, okay, this is basically the whole thing. So what happens when you start control? Let me go to the slide. Okay, so the first thing when you consolidate, this is very important. You have to know what the starting point is, right? So what the starting point is, this is very important. Now, when you're doing consolidated financial statements, you know that you're doing it from a group level, right? So what's going to happen? The first thing is the parent is just gonna take everything from the subsidiary, like it does. So all the subsidiaries financial statements, he's going to add 100% of them to the financial statements of the parent. So he's going to add all of the assets of the subsidiary to the assets of the parent, all of the equity of the subsidiary to the equity of the parent, and all of the liabilities of the subsidiary to the liability of the parent. That's the starting point. That's where we start. So we're gonna add financial records of the parent and the subsidiary, everything we added together. Even with the statement of financial position, we're going to add everything together. That's where we start, right? However, from the illustration I showed you, right, if let's say we just add everything together, right, and show that statement to, let's say, our users, it won't give accurate information, because users are looking at this information from a group perspective. And did you see like the transaction that I like that I showed you before? From a group perspective, there are some transactions that don't happen the same, right? Like in the separate, right? And therefore you have to adjust for those transactions that don't happen like the same. So what's the whole point of doing this group statement? So group statements, basically we are going from combined, so combined, né? So combined. So these general entries are combined. So we are just combining A and B, right? So combined general entries, right? We go from this to consolidated. Consolidated means now it's from a group perspective, no more from two separate entities perspective, just added together. So these are just A and B added together. So this is the starting point, the combined. And then what we do is we want to consolidate. That's why. So what we do, this process here, this whole process here is consolidation. Then here we get our consolidated statement here, right? So this is the consolidated part here. Okay, I won't write everything. Okay, so this is the consolidated part. So what we do here is consolidate. Do you see? This is what we do. This is what they mean when they say consolidate. Change it from combined, meaning just adding it together, and fix basically those discrepancies, right? So how do we consolidate? We consolidate via these journal entries called pro forma journal entries. That's how we consolidate. The only way you can consolidate is via pro forma journal entries, right? Like I said when I started with this, do not forget, we do accounting for information to present statements, and the only way to present statements is via journal entries. So these pro forma journal entries, they help us consolidate this combined to consolidated financial statements. So do you see what pro forma journal entries are for? This is what they are for. So they are not accounting what happened during the year. What they are doing is pro forma journal entries. What do? They do these two things. I hope this one you write them down because it's very important. It's either they fix, right? They fix the discrepancy between the parent and the subsidiary. So between what the parent and the subsidiary did versus what they had to do on a group level. So what they actually had to do, right? So you're gonna look at what the parent did, then look at what the subsidiary did, then look at what it means from a group perspective, and then adjust it so that it becomes very a group perspective. I'll show you how you do that. So the first thing is you fix. Those are what these entries do. They fix and, right? So they do these two things. So they fix and allocate, right? So after fixing, there's general entries here that you use to allocate, right? And where do you allocate? Allocate to non-controlling interest. And I will explain what that means. So these pro forma general entries, they do one of the two. So it's either they fix or they allocate to non-controlling interest, right? Yeah. So now we're still here on the starting point. So now we are here on the starting point. So what happens is at the end of the year, when the business starts with consolidation, the first thing, like I said, the parent will add 100% of their statements with 100% of the subsidiary statements, right? And then what happens is after they do that, we come here. We start with the first pro forma journal entries. And what are they? They are at acquisition pro forma journal entries. They are called at acquisition pro forma journal entries, right? That's where we start first. So this part of the starting point of the groups, you won't write it anyway, right? You just know that that's what happens. In the test, they'll tell you prepare pro forma journal entry. Do you see that? That's why you don't do this one, because this is not a pro forma journal entry. Do you see this one? It's not a pro forma journal entry because it was just combining these two. Pro forma journal entries, they are there to fix and allocate. Do you see that this, you're not fixing and allocating, you are just at the starting point. So that's why it's not called the pro forma journal entry, and you won't really record this. In the question, they'll ask you, do pro forma journal entries to do this and this, right? So here, pro forma journal entries, they start at acquisition. So like I said, they fix the discrepancies, right? So we're gonna start firstly at acquisition, because we have to start firstly at when we acquired the business. Did we record it from the right perspective, right? When we acquired the business. So now, when you acquire the business, what happens is there are firstly what does IFRS 3 say? Business combination. It says you must record the assets and liabilities, right? The net assets and liabilities, these ones, right? You must record at fair value. So these assets and liabilities of the subsidiary, they must be at fair value, right? So the first thing is they must be at fair value. So now what happens is, let's say the subsidiary, like let's say something like, let's say PPE again, in the subsidiaries books, it will be most probably it will be at cost, right? Most probably that thing will be at cost. And what did you do at the beginning of the year? This is what you did. You said 100% of parent plus 100% of the subsidiary. And now the first entry, I said we have to do fair value adjustments, right? If let's say, okay, before I go to the example, so we have to do these fair value adjustments. And why do you have to do these fair value adjustments? So what happens is, when the parent acquires the subsidiary, do you see that the parent is still, like, the parent is not the same entity with the subsidiary yet. So before the parent acquires the subsidiary is just a third party at that point, right? So at acquisition date, all of the assets from the parent's perspective, right, they are at fair value. Let me explain now the difference between cost and fair value, and why like they use different models to calculate something. So when something is at cost, it means that it's owner occupied, or like, and what does owner occupied mean? It means that you are using that asset. So it's not just an investment. You are actually using that asset. Like for instance, PPE, you have equipment that you are actually using in your business, right? By intangible assets, you actually use them in your business. Basically, your business is paying much attention to those assets. However, something like, say, like investment property, right? Investment property, the business does not necessarily use that building for business purposes. Like, let's say if that building was used maybe to manufacture maybe cars, then that building, yes, it's used basically by that business. Like the business like takes time on that asset. However, let's say investment property, do you see that investment property, something like flats, for instance, because in investment property says like rentals, right? Something like flats, yes, you do general maintenance there and there, right? But it's only there, general maintenance. You don't do more than that. You're not actually invested in that business. Like, so you don't spend time in that particular asset, right? That's why it's measured like at fair value, because basically, who determines the value of that asset? It's not you, because you're not really using that asset. If you're using that asset, yes, you determine the value. That's why you calculate at cost and use the own depreciation model. But here you use fair value, because why? It's used by other people. So that's why investment property said rental or capital appreciation. So what does capital appreciation mean? It means that we just have a building there that you're not using, right? So its value is derived by the market if that's the case, right? So if something is not ours, or we are not investing too much time in it, so if you are not investing much time in that asset, then we have to look at it from a fair value point of view, right? Now, look at this when we start with the parent and the subsidiary. When the parent buys into the subsidiary, all of those assets and liabilities at this point in time at acquisition, they are not yet part of the parent's books, right? So still the parent, it sees those assets and liabilities as fair value. They must be recorded at fair value. They are determined by the market, the value of those assets, because they are not yet used, right? Then what happens is now IFRS 3 says you're going to remeasure all of the assets and liabilities of the subsidiary at fair value, right? Now, in a test, this remeasurement, they'll just tell you that after remeasuring the assets and liabilities, we found that maybe PPE was undervalued maybe by 10,000, right? They will tell you these fair value adjustment, that something is undervalued by this much or overvalued by this much, and then you have to do the adjustment, right, to actually value it correctly, right? So do you see that we are actually changing this combined, because this was from the subsidiaries point of view, right? Because combined is basically from the separate point of view. So combined means separate point of view, and consolidation means group's point of view. So do you see that from the separate point of view, it is right, Vele, that that asset, let's say it was land and it was like something like 90,000. That land, it was perfect, Vele. It is 90,000 from the combined brackets, right? But the reason why this journal entry now to adjust this land amount, the reason why it's called the pro forma journal entry is because we are now adjusting this thing to look so that this thing looks like a group, like from a group perspective. So from a group perspective, what's going on? From a group perspective, at acquisition, when we acquire these assets, we see them at fair value, right? Let's say the fair value is 100,000. What happened at the starting point? We added 90,000, right? So what must we do? We must do a pro forma journal entry, right? Change this combined to consolidated by doing what? By recording that 10,000 of land, right? So we're gonna record the 10,000 of land by saying land we debit by 10,000, right? And then equity at acquisition. So what is this equity at acquisition? It's sort of like the gain that you received at acquisition, because think about it properly. Ne? This is actually a gain that you received at acquisition, right? This equity at acquisition, because the credit balance. Why? Because the subsidiary thinks that this land is actually 90,000, but this land is actually 100,000, right? So this this is basically it shows the gains or the losses. This equity at acquisition, it accumulates all the gains and losses at acquisition. So what happens is, let's say the next one is maybe something like let's take something like maybe it's something else. Maybe maybe it's in it wouldn't be investment property. Okay, maybe it's intangible assets. Ne? So what happens is, let's say those intangible assets were maybe undervalued. Because they're undervalued, you're gonna have to increase it. So you're just gonna say intangible asset you debit, equity acquisition you credit, right? Equity acquisition you credit, and then um let's say it was overvalued, you are just gonna credit the intangible asset and then debit equity at acquisition, right? Because if, let's say, maybe this land was overvalued, that means that we lost, basically, like there's a loss, right? There's a loss because the way the subsidiary sees it and the way the group sees it, it's different, but it's a loss. So this equity acquisition, it will be a loss, right? But what I'm trying to say is that these fair value adjustments, you all accumulate them in this equity at acquisition. And let me tell you, this deferred tax, ne, I am going to explain deferred tax like deep. Ne. However, for now, just know that for groups, deferred tax will always be simple. It's the simple part, but do not forget it. Do not forget deferred tax, even for groups. So do you see that this equity acquisition is an equity account, right? I just forgot to put in the SCE here, but this will affect an equity account, right? Because it affects an equity account, anything that affects an equity account, it affects basically deferred tax, right? If it affects an equity account, an equity account that specifically affects retained earnings, right? Because do you see that this will affect, obviously, your earnings? It will affect your earnings, this, right? This equity acquisition. You will see what I mean when I say deferred tax. You will consider it only when it affects like your earnings. So earnings is like profit. So in this case, this equity acquisition is SCE. So the deferred tax, what you do is, let's say it's 10,000, right? This land, right? Land is gonna receive its 10,000. Now know that this deferred tax, it will always follow the equity acquisition. So if the equity acquisition is credited, deferred tax will be credited. So for now, like get it that way. I will explain why like it happens like this every time. But for now, just know that this deferred tax will follow the equity at acquisition, because to explain why it follows it, I'll have to explain what deferred tax is like from the beginning and really explain it. So here, just know that, let's say this land was created, because you're going to look at this land first, because this it's the item that you're working with. It's the one that was it was over or undervalued, right? Let's say it was undervalued. The first thing is you're going to create this land, right? Now you know that because you created land, you're going to have to debit equity acquisition. Don't forget to also debit deferred tax, because that equity acquisition amount is affected by deferred tax. The land will be 10,000. It won't change that amount of 10,000, but the equity acquisition will not be 10,000. It will be less than 10,000, because deferred tax has a portion in it every time. Do not forget this deferred tax. I don't know how many times I forgot it. Please do not forget this deferred tax. These are just easy marks. And then, however, I will compile like a framework with like detailed steps for step 1. Do this. Do not forget this. Later, like I said, today is just an introduction to all of this. So this is the first pro forma general entry. Do you see? You record at acquisition. This is the first pro forma general entry you record, and then after this, after you record the general entry, after you do the general entries, please, you have to start preparing your analysis of equity. Never do group statements without preparing the analysis of equity, right? Because like I said, group statements are these pro forma general entries, right? But the amounts that go into these pro forma general entries, it's easier to calculate them using an analysis of equity, right? These amounts that get into these pro forma general entries. So this is how this analysis of equity relates to this pro forma general entries. It's easier to calculate these amounts using the analysis of equity. So from here on, start drafting your analysis of equity, right? So how is it gonna look? Analysis of equity, in most cases, it has that column, right? Firstly, the NCI column, and then it has the column for the non-controlling interest, and I will also explain what this means. And then it has what you so the percentage allocated to the parent, right? It has the percentage allocated to the parent, and then here it's basically where you write the share capital. So at acquisition, that's where you write your accounts here, right? Now that's where you write your accounts here at acquisition, right? So let's move on, right? So now we are going to, after these, so after you are done with, after considering this, okay, now in considering this, before I move on, but I will also go deep into this, like I said, in the next session. This don't forget that these fair value adjustments in the standards, there are those items that are also included, but they are not included at the fair value. Like something like employee benefits, it will be at cost. There are certain exceptions to these fair value adjustments, right? And then don't forget also, there are items at acquisition that are included that were not like, so from the subsidiary's point of view, the subsidiary didn't record it. However, from the group's point of view, you have to record it. Like things like, for instance, intangible asset, for instance. If agree, for intangible asset, you have to be, it has to meet the definition and recognition criteria. However, for group statements, they said if a subsidiary has an intangible asset that so that meets the identification criteria, then it can be recorded in the group statement. So it's taken as it can be recognized. So obviously the subsidiary will not recognize that intangible asset, right? So at the starting point, that intangible asset is not there. However, from a group perspective, it has to be there, right? So because that's the case, you know that you have to have a pro forma general entry for it, right? Because you are correcting basically what this guy did. So what happens is, because we are going from we are going from combined to consolidated, like I said. And these exceptions, these exceptions, like it's sort of like a list of them. So in some questions they might focus on them, but I think on a third year level it's not really the focus, right? The focus is, can you actually do like group statements like holistically, right? Can you do the entire like of group statements? But with things like intangible assets, they will pop up. So how are you going to record something like that? You are gonna say intangible asset, you debit, right? Let's say there was intangible asset maybe of like, let's say 500,000, right? 500,000. So in the statements of the sub, that 500,000 is not there like as an asset in, yeah, for those intangible assets, not there because it didn't meet the recognition criteria. However, it meets the definition criteria. What will happen is that the pro forma journal entry, do you see that intangible assets as a whole are undervalued, right? They're undervalued by 500,000 because this guy didn't like record it, right? So what do? We have to do a pro forma journal entry that increases that amount, right? Because it has to be from a group perspective. They said from a group perspective, when the subsidiary has an intangible asset, right, identified it, it has to record it. So from a group perspective, we have to do it. So we have to do this pro forma journal entry and say intangible asset we debit, and then we credit equity at acquisition. Do not forget again the deferred tax, right? Do not forget again the deferred tax because it means that it's undervalued. Even something like a contingent liability. Contingent liability, they are not. Do you know that contingent liabilities are not actually presented, right? They are not recorded. You don't have a journal entry for contingent liabilities, right? You do have a journal entry for provisions, but not contingent liabilities, because contingent liabilities are disclosed. They are not presented, right? So what happens is, from a subsidiary's point of view, you will not have that contingent liability. Let's say you have contingent liability of 200,000. You will not have the 200,000 there, right? So do you see that there is this liability, like, but however, from the group perspective, the standard says all contingent liabilities that were there in the subs records, as long as you have a reliable estimate for those contingent liabilities, we have to record it like a normal provision. So we have to record it like a provision. So what happens is a provision now is a liability. Here they didn't record the 200,000 because it was only disclosed, right? What happens is you have to do a pro forma journal entry where we actually record it. Do you see that? Like every time, what I'm trying to show you is, if you can't see the link between it coming from combined to consolidated, then that pro forma journal entry, you don't know what you're doing. So like I said, this starting point is very important to know it because that's where things like start, right? So like I said, for that contingent liability, from a group perspective, they're looking at it as what? This is a normal liability. But from a combined entry, so separate, this guy didn't record that liability because it must be disclosed in a separate. That's why I'm saying perspective is very important. Then what happens is, what journal entry are we going to process on a group level? So what pro forma journal entry are we going to process? We are going to say that liability we credit, right? Liability we credit, right? And then what do we debit? Equity at acquisition. So do you understand what I mean? Everything at that point will be taken to equity at acquisition, right? So, however, I will give you a list of the exceptions, but today I just wanted to drive this point home, right? That there are these fair value adjustments and there are exceptions to these fair value adjustments. These fair value adjustments are recorded at the equity acquisition, and do not forget deferred tax. Please do not forget deferred tax. Like I said, I don't know how many times I forgot deferred tax. There are tests that I actually failed because I forgot this, right? Like maybe a whole 10 marks because of I forgot deferred tax. Please don't forget deferred tax, because on a group level, like I said, it's very easy. You will see, like I said, you see with here, like it will always follow equity at acquisition. You will see even when you continue, deferred tax will be simple from here on. That's why I'm like, do not forget deferred tax, please. And then after you are done with these, right? So like I said, they have exceptions and I'll go deep into them. So after we are done with this, said you prepare the analysis of equity, right? And then we start with this main elimination journal entry. So I want to go to this main elimination journal entry. What is this main elimination journal entry, right? So Firstly, ne, so firstly, what happens is this journal entry. Ne, what I can assure you, what I can tell you is this journal entry. Just know it as I hope you're writing it down. Yeah, I just wanted even to type it here. Yeah, this is the journal entry for ne, for recording, because I want you to remember this. So for recording goodwill and goodwill or gain on bargain purchase. Ne? So this is basically one of the reasons why we are doing it. Like I said, this is one of the reasons. It's not the only reason, but it's the main reason why you're doing it. It's for this goodwill and or gain on bargain purchase. Right now, let's go to this main elimination journal entry and see basically how it looks. Right. So okay, let's go here. So how does it start? Ne? Now, you know that from here, so from the starting point, we said there was 100%. So let me just type it here. So there was 100%, right? 100% of 100% of the parent plus 100% of the subsidiary, right? You'll see I will always go back to the starting point because that's what we are doing actually here. We are fixing, right? So we're at the main elimination journal entry. So the first thing is you have to debit the equity. So you have to debit all the equity. So all the equity from the sub. That's the first thing you do, right? You're gonna take out all of that equity from the sub. So I am talking about share capital, retained so share capital, retained earnings, all of those amounts you are gonna take out first, right? So that's where you start. You start by debiting all of those amounts at acquisition. Like I said, where are we? We are still, let me go here. We are still at acquisition, right? So we are still at acquisition. So what are you gonna do? You're gonna take out the share capital at acquisition, retained earnings at acquisition. If maybe there was maybe revaluation surplus because it's part of equity at acquisition, why are we taking them out? That's because do you see that that equity does not belong to us as a group? Because before acquisition, we hadn't, so those that equity came before like we actually acquired the business. So what happens is we have to eliminate it. It's not a part of this group from a group perspective. That equity that came before acquisition, right? That's why the share capital, the retained earnings, all of those equity amounts at acquisition we have to eliminate, right? That are from the subsidiary, right? We have to eliminate. That's why we debit these equity amounts. And that's why even here on the so analysis of equity, you'll see analysis of equity, it will have firstly all of the equity of the subsidiary at acquisition, right? That's where it starts because it starts at acquisition. So all of the equity of the subsidiary at acquisition, right? And this also includes equity acquisition. So this account that we've been doing here, equity acquisition, it also includes this equity at acquisition, right? Because that's the equity acquisition. We are taking it out, all of that equity at acquisition. We are saying this is the equity of the business at acquisition. So we are taking out the equity of the business at acquisition. That's what we are doing. We are taking out that equity of the business at acquisition from obviously a group level. We are taking it out, right? From a group level, we are taking it out. So now don't forget, even if that equity acquisition, let's say that equity acquisition, you have a debit balance, right? Because you have a debit balance, you're going to credit the equity acquisition. So you won't debit it here, you're going to credit the equity acquisition. But what I mean is by debit is we are taking it out. The reason why we are debiting here is because obviously when the subsidiary, then the parent added the subsidiary's records, right? When the parent added the subsidiary's record, the parent also added all of their equity, right? So how do you eliminate that equity? You eliminate it by debiting it. And how do you eliminate the equity? Let's say equity acquisition. If it was a debit balance, you're gonna credit. So if it was a credit balance, you're gonna debit, right? That's the first thing you do. So so basically that's the equity that we bought at acquisition. That's the equity that we bought at acquisition. That's what it means, right? We take it out, right? Because from the group perspective, you cannot buy like from yourself, right? So you have to take it out. That this is the first thing, right? And then the second thing is, oh, that's what we debit, right? So we debit this, and then what do we credit? We credit, number one, we credit the non-controlling. Okay, before I go to the non-controlling interest, okay, yeah, let me go to it. Yeah, non-controlling interest, right? So with regards to this non-controlling interest, there are two ways. So okay, before I explain how to calculate this, so what is this non-controlling interest? This is basically the interest that we are attributing to the non like the so the 40%. So because we own 60%, the non-controlling interest is the 40%. Like I said, do not forget this. Like I said, when I started with this statement, what do you have? You have assets at the top, right? Then you have what funded those assets, right? Do you see here we have this credit balance? This NCI is going to be at equity. It's going to be an equity balance, this NCI, right? Because from a group perspective, do you see that those assets, some of those assets are funded by the NCI, right? Because we have the entire asset, we have the entire asset here. So some of those assets are funded actually by the NCI. That's why this NCI we have to record. Mare, I will explain it like deep as we go. Just know that we are recording it because these assets are recorded there, right? And we have to show what funded these assets, right? Remember that we didn't fund like these assets alone, right? We funded them with this non-controlling interest. Just like when we take out a loan, right? Obviously, you take out a loan to buy something. Maybe you take out a loan to buy PPE, right? You are going to record that loan. Why? Because that loan was used to fund those assets, right? So this NCI is used to fund. So it must appear there from a group level, right? Because from a group perspective, you contributed equity, and the non-controlling interest, they contributed equity, right? So that's why you have to. So this equity that we recorded here, this is the entire value of the business from a group perspective that we are taking it out, and then what we're crediting here is the non-controlling interest, meaning the portion that's attributable to those that other 40%, right? And this can be recorded either, number one, at the fair value. So they can give you the fair value, right? And say it's measured at fair value. So it can be measured at fair value, or so they can tell you that this is the fair value. So that's simple. The fair value, just take this fair value they gave you and credit it, right? Say NCI, or it will be at the so it will be at the proportional, right? Proportional, right? It will be at the proportional. So net assets and liabilities, and I'll explain how you get this one. So proportion of net assets and liabilities, right? Liabilities at acquisition, right? So proportion of the net assets and liabilities at acquisition. Now, where do you get this proportion of net assets and liabilities? This is basically the net assets and liabilities. So that equity that we debited, that's the net assets and liabilities. That's the net assets and liabilities, right? Because you know that equity is equal. What do you mean? Assets is equals to. Again, we know that assets, right? We know that assets is equals to owner's equity, right? Plus liabilities. That's what assets are equal to. So owner's equity plus liabilities, right? So what does basically I get it, this net assets and liabilities. What does net assets and liabilities mean? It means assets minus liabilities. I get net assets, it means assets minus liabilities. So when I say this assets, so what is assets minus liability? So assets minus liabilities, do you see that it's equal to equity? If we take this L, this side is going to be a minus, and then assets minus liabilities is equals to equity, right? So what are they actually saying here? Give us the fair value or the proportional equity at acquisition, right? That's what they mean and say net assets and liabilities. So you can literally go and calculate I mean, you can literally go and calculate, basically take the fair value of the assets minus the fair value of the liabilities, or you can just take the equity. It's the same amount that you're gonna get, because assets minus liabilities equals equity. So I'll suggest you use just this amount that you got. So just accumulate all of that equity that you have, add it up together. That's what you do. You add it up together, then you have these net assets and liabilities. And what you do, you multiply it with the NCI percentage. So what's the NCI percentage in our example? It was 40%. So you're going to multiply those net assets and liabilities by 40%. That's what they mean here. You're going to multiply those net assets and liabilities by 40%, right? If that's the case, or they will give you the fair value. Don't forget that these net assets and liabilities, right? It's equity, and I said the equity from the sub. Do not forget equity at acquisition. So even if, let's say, the equity acquisition here, you've got all of your equity obviously credited, and then maybe let's say equity acquisition, you've got it I mean, you've got all of this equity debited, and then you've got this equity acquisition that you credited, right? When you're calculating this net assets and liabilities, don't forget to add all of that equity and minus the equity at acquisition, because that equity at acquisition is part of the equity, right? It's just that you made a loss this time instead of like a gain. If it's a gain, it will also be part of this equity balance, right? So do not forget that. That's basically how you calculate NCI at this point, right? That's NCI. And then once you're done with this NCI, the only thing that's left to actually credit. So the only thing that's left to credit here, it will be credit. You're gonna credit what? The consideration, right? Consideration, right? And what is this consideration? Yeah, you're gonna credit this consideration at fair value, right? So the consideration that you paid at acquisition, that's what you also credit, right? So you credit this consideration that you paid at acquisition, right? You credit this amount. That's the thing you credit after the NCI. You credit the consideration, and don't forget this consideration. Where is it? It's in the parents' books, right? It's in the parents' book. Like I said, this main elimination journal is like you cannot invest in yourself. So this equity that you invested, you take it out, right? At acquisition, and then you transfer it to the non-controlling interest, some of it, right? And then with this consideration, don't forget this consideration, where is it? It's currently contained in the parents' book, right? Because don't forget, what did we do in the separate financial books of the parent when we bought this particular investment? We recorded this journal entry, right? This one, and not that one, I mean this one, right? We recorded this one. So currently we have this investment in B, right? We have this amount, and this amount is equal to this consideration. So what do you credit? The account will not be consideration. It will not be called consideration. The account will actually be called the account. So when you're doing the general interest rate, you will not call it consideration. The account is actually investment, right? Investment in B, right? It's investment in B, because investment in B has that basically amounted fair value, right? So we have to take it out. Do you see that date was debited here? We credited, and is that fair value amount? So we took it out, right? Now, let's say, so let's look at this now. So what happens is this equity that we taken out, it's the total value of the business at that point at acquisition. So this is the total value of the business at acquisition, right? This is the value of the business at acquisition. And what? A portion of it, because we didn't buy the entire business, a portion of it must go to what? The non-controlling interest, right? That's why we took away their portion, right? Or like this fair value. That's why we took away their portion, right? So what's left after we take away their portion, this NCI, whatever is left here is the portion attributable to us, right? And what did we use? We used this investment to pay for the portion that's left, right? We used this investment to pay for the portion that's left. Let's say the equity here, like the equity amounts, like if we sum them up, all of them, we get maybe something like 100,000. right? And then obviously, let's say it's not fair value, it's net proportional, right? Because it's net proportional, we're gonna say that 100,000 multiplied by 40,000, and then we get 40,000. So it's gonna be 100,000 that we accumulated here of the equity that we debited, and then we credited what 40,000 for the non-controlling interest, right? Don't forget this equity from sub. You won't write equity from sub. You'll write like literally share capital, retained earnings. It's just all of those equity from the subsidiary. Like I said, today I'm not going like really deep, like in detail. I wanna cover the surface like of it to see why we actually do what we do. So it's this, and then after what's going on is we took away this 40,000, right? So what's left is 60,000, right? Now let's say here, well, our total consideration we paid like 50,000. Let's say we paid 50,000, right? Do you see that after the NCI has taken their portion, the 60,000 that's left is our portion, but we only paid 50,000, right? So do you see that we paid less than this thing, like it's actually worth, right? So we basically made a profit on the sale, if you can say. So we made a profit on the sale, right? So what you're gonna do is you're gonna credit, because obviously this credit amount is less, right? You're gonna credit what? Credit basically gain on bargain purchase, right? That's what you're gonna credit, a gain on bargain purchase, because what happens is you got a gain, right, on this purchase. That's why it's a gain on bargain purchase, and you credit it SCE, right? And then if let's say like the investment, maybe we paid maybe 90,000 for it. Do you see that 90,000 is more than 60,000? So we actually paid more than this thing is actually worth, right? So we paid more than this thing is actually worth, right? So we paid more than this thing is actually worth. And what does that mean? That portion that we paid more, where is it debited? Because it's taken somewhere, right? That portion, that 30,000, that 30,000 will be taken to goodwill. It's called goodwill, right? And why is it not called a loss? Right? Because obviously gain on buying purchase is like a gain, right? That's why we take it to equity. We take it to our reserves, that SCE. But why is the goodwill? Why don't we take it to the reserves? Why do we say goodwill? Because goodwill, you know that goodwill is an asset, right? Why for goodwill, why do we say is goodwill is actually an asset? Why do we do that? So think about it properly. You bought assets from this subsidiary, right? Assets and liabilities, right? Because you bought a stake from it. So you basically bought their assets and liabilities and their equity, right? You bought everything from them, but only obviously 60% of it, right? So what happens is, what is a business? A business is not only those assets and liabilities. No, it's actually more than that, right? A business is how they use those assets and liabilities to generate um money, right? That's a business, right? I mean, I can sell you the same assets and then you can incur the same liabilities, right? But that doesn't mean that like you have a business. It's actually when those assets and liabilities, they work together, right? And what is that called when they work together? That's called synergies, right? So they have synergies, these assets and liabilities, they have to have synergies, right? And then for those synergies, that's also valuable. So let me give you like maybe an example. Let's say you have two stores. Now I'm gonna give you two examples. Now you have two stores, maybe one here, maybe one maybe there, like in the rural areas there, maybe yeah, one here, maybe one in the rural areas there, maybe northwest or something, right? Yeah. Or let's give like a better example. So you you have a business here and one like in the township, right? So suburb and township, right? At this day and age, right? So if two stores, these two stores, they have the same assets, right? So they are, let's say they are internet cafes, ne? So so let's say I give them so I invest in these two businesses, one this side, Auckland Park, and then one in the township, right? Maybe Soweto or something like that. And then what happens is I give the shop in Auckland Park the same assets that I give to the shop in Soweto, right? So let's say these assets are computers and printers, right? So computers and printers, obviously that's what you use for internet cafe, computers, printers, Wi-Fi, like it's that, right? Now let's look at these businesses. Ne? Obviously, because it doesn't mean that because I gave this business the same assets, like the business in Auckland Park, the same assets as the business in Soweto, that these two businesses are gonna be valued the same. They're not valued the same, right? Because its value is gonna be derived by the business that's actually making the most money, right? Let's say the one here in Auckland Park is not making money because most students, like, they have Wi-Fi in their area, and I mean, even in school, there are printing facilities. So which means a business like that will not survive here. But let's say in the township, they don't have those facilities, right? Therefore, it will work. So what does it mean? It means that the synergies here in this area are not as high as the synergies in that the like Soweto, like in the township. So let's say we buy the business. Obviously, this business, when I buy it, I'm gonna pay less for the one here than the one in Soweto. Let's say, or let's say I sell this business because I'm the one who owns it. When I sell it, I'm gonna sell this one, the one they at Soweto at a higher price than the one here, right? Why? Because the one at Soweto has more synergies than the one here. And what are those synergies called? Those synergies are called goodwill. That's goodwill. That's why we record an asset. So we are recording those synergies, the value for those assets working together, right? It's not a loss. The fact that you paid more uh, for what, like than what the assets are actually worth, doesn't make it like a bad investment. It's not a loss. That's what they're trying to say. That's why it's not an expense. It's not a loss. However, if you buy it for more than it's actually worth, it's a profit. But if you buy it for more than the assets are actually worth, right? That's goodwill, because you the reason why you paid more is because you see that the synergies, like, are actually worth more, right? So that's why it's goodwill, and goodwill is an asset, right? Goodwill is an asset, right? So here it's either you're gonna have goodwill or gain on bargain purchase, like I said, goodwill or gain on, so gain on bargain purchase. And listen, like, for third year, it doesn't matter what they ask you, whether they ask you just to calculate goodwill, like, on the side, or just calculate NCI, use journal entries, because that's how you know it. Use journal entries and then give them the answer they want. They will take it. Because you did it the way that's correct. So do journal entries and then give them in the format that they want it. But the calculations, do them via journal entries. Ne? So even though they want goodwill, do not calculate goodwill using their formula. It's going to confuse you. Yeah. Calculate it using journal entries. Then after, that's the main elimination journal entry. You are done with the main elimination journal entry. Let's go back here. So that's the main elimination journal entry, right? Do you see, for recording goodwill or gain on bargain purchase? So that's that's the main elimination journal. And the reason why they call it the main elimination journal, do you see that it's eliminating value, this investment value, it's eliminating the equity that we recorded and eliminating this investment, right? And where is it taking it? Is it taking it to NCI and creating this goodwill? So that's the main elimination journal entry. And after you are done with the main elimination journal entry, you are done with add acquisition journal entries. So this part of the so the add acquisition part, do you see that you are even done with it? So even here in the analysis of equity, you're going to have all of your equity here, right? And then at the bottom, you're going to have consideration, right? And then show goodwill, right? And this attribution to NCI, right? Because what happens is you're gonna have this equity here minus what, the consideration, right? It gives you what? Oh, I forgot this. Yeah, it actually has, sorry, it has 4 columns. This thing, it has 4 columns. Don't forget the 100% column. So there's a column where it has an accumulation of all of these things, right? So the 100% column, and then they're attributed after. Yeah. So what happens is, here in this column here, you're going to have the total full amount. So this is the total investment, right? So so after you said the equity, right? So this is the equity again. Then after you say this equity, you're going to have an amount here for all of this equity, like total, right? And then what you're gonna do is you're gonna allocate this equity to these columns, right? Allocate it to these columns, right? And then after allocating it to the column, you're gonna have consideration here. Obviously, this consideration is not for the non-controlling interest. This consideration is only for this column, right? It's not for the 100% even column, it's for only this one, right? So what you're gonna do is this consideration, you're gonna have it here, right? And then what is the answer it's gonna give you here? It's the goodwill or the gain on bargain purchase, right? Do you see? Because this amount does not have the NCI. So it's this amount minus the NCI, it's this amount, like we have here. Like we have here, like we have here. You see here, it's this equity. So this 100% from taking all of this equity and adding it up together, like I said here. And then here we attributed, right? We said that amount times 60%, right? So it's like we had that 100,000 here, and then times 40, we said times 40%, which is we put it here. Obviously here it's 60%, right? Like I said, you see it's the 60,000. And then what happens is what you create here is the consideration, right? Which is this investment, right? Do you see? And then what you get here is the goodwill or the gain on bargain purchase, and that's how they do it on the analysis of equity. But I will go into detail other sessions, like in other sessions, but that's how you do it in the analysis of equity. Yeah, that's how you do it in the analysis of equity. So that's at acquisition. So we are done with at acquisition. So those are the only at acquisition pro forma journal entries. Yeah. These are the only at acquisition pro forma journal entries. Those are the only at acquisition pro forma journal entries, right? Now we move on. So after at acquisition, what happens is we've now acquired this business, right? Now we must look at what happens from that acquisition until the end of this year, right? And what we are gonna do there, like it's simple, like really, and I don't know like why we are not like taught this way. So what you do is you're just gonna fix the discrepancies between the assets and liabilities you adjusted for at acquisition first. So you're gonna firstly go to those assets, these ones that you adjusted for fair value adjustments, right? And then see from that acquisition, right, how the group and basically the parent and the subsidiary recorded it. So let me give you an example. So let's say here we adjusted for PPE. Let's say PPE we debited. Do you see that PPE now in our records is more than what the combined says, right? So this PPE, we have a higher PPE amount, right? So let's look at what's going to happen in the parent and the subsidiaries perspective, and then what's going on in the group perspective, because that's what we are doing here when you're consolidating, right? So from the combined perspective, so separate perspective, what happened? This PPE, where it contained is it's in this subsidiary, right? The subsidiary took this PPE, let's say it's 90,000, took this PPE, and let's say the rate of depreciation is 10%. It took this PPE at cost. So it took this PPE and said 10%, right? So 90,000 times 10%, that's 9,000. So it said depreciation, you debit 9,000, and then it credited accumulated depreciation 9,000, right? Now, what did we say? From a group perspective, that's wrong. That PPE amount is not, it is not 90,000. It's actually 100,000, right? It's actually 100,000. So for this year, what are you gonna do is you're gonna adjust the depreciation figure, right? By saying depreciation you debit by 10,000. No, not 10,000. I mean, you're gonna say that 10,000, right? Because so first you're gonna say 100,000 multiply by 10%. No. Let's say yeah, Mara, it is correct. It is correct because that 90 is at cost. Yeah. So it's 9,000. And then let's say the value of that PPE it was 100,000, right? So you're gonna take that 100,000, right? And then multiply it with the 10%, right? What you're gonna get is 10,000. So they had to record a depreciation amount of 10,000 instead of 9,000. Do you see? So which means the depreciation figure is lower than it actually should be. So what must you record? you must record an additional 1,000 depreciation for that portion. So it's going to be depreciation, you debit with 1,000, and then you credit accumulated depreciation with another 1,000. And that's the pro forma journal entry that you do. That's what I mean when I say fix the discrepancy. So you're going to fix the discrepancy of these assets and liabilities. And then even with this one, I'm going to go like in detail next session. This is where I'm going to go in detail. And then number 5 is fix the discrepancy between the parent and the subsidiary. So what they did, that's what the group wants. So you're gonna fix now everything that happens after acquisition now, those discrepancies. And the next session is basically me explaining to you how you fix those discrepancies from since acquisition, because that's group statements. And then when you are done, you allocate and attribute, and then you are done with group statements. That's group statements in general. So today I just wanted to show you the story of group statements, and then I'll go in detail next session. I hope that session was productive, and thank you. We meet for, so we have another session. So we have another session next week. Next week we'll have another session. I'll announce exactly when next week, but it'll be weekend. Thank you.